mind that a dividend is money which is not reinvested to grow the business. However, it's not all rosy. Let's now see the downside of ETFs. Some challenges of ETFs include liquidity issues. Not all ETFs are highly traded. This might be a problem if you need money and want to sell quickly. Tracking errors. Sometimes the synthetic replication ETFs might not precisely mimic the indexes they track. Minimum investment. Certain ETFs require a minimum amount to be invested. Based on this, let's see the criteria you should consider before buying. Before plunging into the ETF market, it's pivotal to evaluate several factors to ensure a sound investment decision. Objective. Begin by understanding the core goal of the ETF. Is it growth-oriented, value-driven, or focused on income generation? Market cap. The total market value of an ETF provides insights into its size and stability. Larger market caps often imply more stability, albeit with potentially lower growth prospects. Performance. Historical performance, while not an indicator of future results, offers insights into the ETF's track record in various market conditions. Composition. Scrutinize the assets within the ETF. A diverse composition can mitigate risks associated with any single asset class. Concentration. Ensure that the ETF isn't overly reliant on a few assets. High concentration can lead to increased volatility. Turnover. A high turnover rate can indicate frequent changes in the ETF shares, potentially leading to higher costs, while a low turnover might suggest a more stable buy and hold strategy. Max drawdown. This measures the largest single drop from peak to bottom in the value of a portfolio. A lower max drawdown can suggest lesser volatility and risk. Dividend. Examine the ETF's dividend yield and history. A consistent dividend payout might indicate a stable set of underlying assets. Expense ratio. This represents the annual fee that all ETFs charge their shareholders. It's crucial as it does impact net returns. It should be checked in light of the performance. For example, an ETF with a higher expense ratio but a high performance might be more valuable than one with a lower expense ratio but also a lower performance. Liquidity. Ensure the ETF trades sufficiently, facilitating smooth entry and exit points. With these criteria in mind, we will now examine different types of ETFs from the main issuers to help you select the best ones for you, depending on your objectives and investor profile. We will first compare 3 ETFs tracking the total U.S. market. 1. The Vanguard Total Stock Market ETF, or VTI. It is an exchange-traded fund offered by Vanguard that aims to track the performance of the CRSP U.S. Total Market Index. This index encompasses the entire U.S. stock market, including thousands of stocks from companies of all sizes and sectors. 2. The iShares Core S&P Total U.S. Stock Market ETF, which is traded under the ticker symbol ITOT. This ETF aims to provide investors with broad exposure to the entire U.S. stock market, including large, mid, small, and micro-cap stocks, listed on the NYSE and NASDAQ stock exchanges. It is issued by BlackRock. 3. The Schwab U.S. Broad Market ETF. With the ticker symbol SCHB, this ETF aims to track the performance of the total U.S. stock market by tracking the Dow Jones U.S. Broad Stock Market Index, providing investors with broad exposure to U.S. stocks. It is issued by Schwab. Here is a comparison of the performance of these ETFs in the last 10 years using the site portfoliovisualizer.com. Actually, all 3 graphs are overlapping, and if you had invested $10,000 in 2013 and reinvested the dividends, you would now have roughly $37,000 with all 3 ETFs. This corresponds to an average annual growth of about 13%. The max drawdown in all 3 cases is about minus 24%. Let's now compare in detail the main criteria we discussed earlier for each of these 3 ETFs with the site seekingalpha.com. The market cap is much higher for VTI, with $317.62 billion. And there is also a much higher liquidity for the ETF, with 2.81 million shares exchanged daily, corresponding to $621 million, while ITOT and SCHB are only $95 million and $34 million, respectively. The other criteria, holding, expense, and dividends, are similar between all three ETFs. Hence, I think that VTI represents a much lower risk ETF. Let's now compare ETFs tracking the global market. 1. The Vanguard FTSE All-World ex-US ETF, with the ticker symbol VEU. This ETF is managed by Vanguard and aims to track the performance of the FTSE All-World ex-US Index. The index includes large and mid-cap stocks from both developed and emerging markets, excluding the United States. VEU can be a useful tool for building a well-rounded and internationally diversified investment portfolio. 2. The Vanguard Total World Stock ETF, with the ticker VT. This ETF is also issued by Vanguard and aims to track the performance of the CRSP US Total Market Index, which includes both US and international stocks. It provides investors with exposure to a broad and diversified portfolio of global stocks. 3. The iShares Core MSCI EAFE ETF, with ticker symbol IEFA. The issuer is BlackRock, and it seeks to track the MSCI EAFE IMI Index, composed of large and mid-capitalization developed market equities, excluding the US and Canada, but including Europe, Australia, and the Far East. 4. The Schwab ETF SCHF, which stands for Charles Schwab International Equity ETF. It is an ETF offered by Charles Schwab tracking the performance of the FTSE Developed ex-US Index. The index includes large and mid-cap stocks from developed countries outside the United States. Let's first analyze a graph comparing the performance of the three ETFs excluding the US market, VEU, IEFA, and SCHF, in the last 10 years. If you had invested $10,000 in 2013 and reinvested the dividends, you would now have about $17,000 with SCHF, $16,000 with VEU, and $17,700 with IEFA. This corresponds to an average annual growth of about 5.16%, 4.55%, and 5.51% respectively. The max drawdown in two cases is about minus 27% and minus 28% for IEFA. If you remember the previous analysis, for the US total market, the average annual growth was around 13%, while the max drawdown was in the same range as those ones. Hence, let's compare now VT and VEU, which respectively include and exclude the US market. There is a huge difference of performance of these two ETFs, with an average annual growth of about 8.99% for VT, which includes the US market, and only 4.55% for VEU, which excludes it. About half the performance with a max drawdown in the same range, minus 25% versus minus 27%. Let's now compare the other criteria for all four ETFs. The number of holdings is similar for VEU and IEFA, around 3,000 companies, while it is of about 1,500 for SCHF and 9,600 for VT. The expenses and dividends are within the same range for all four. The market cap is about $30 billion for VEU, VT, and SCHF, and $98 billion, about 3 times more for IEFA. Similarly, the liquidity is around $100 million for VEU, VT, and SCHF, and $442 million, about 4 times more for IEFA. Hence, I think that IEFA is clearly the best if the US market is excluded, with higher market cap, higher liquidity, and higher performance. But as we have seen before, the performance is much higher when the US market is included in the ETF with VT. The choice of including or not the US market depends on you and your strategy. We will now compare the ETFs which track the S&P 500 index, which is the stock market index tracking the stock performance of 500 of the largest companies listed on the stock exchanges in the United States. We will analyze 1. The Vanguard S&P 500 ETF with ticker VOO is a popular exchange-traded fund that is proposed by Vanguard. 2. The iShares Core S&P 500 ETF, which trades under the ticker symbol IVV. It is issued by BlackRock. 3. The SPDR S&P 500 ETF Trust, with the ticker SPY. The issuer of the SPY ETF is State Street Global Advisors. SPY is structured as a unit investment trust, UIT. It holds the actual stocks in the S&P 500 in the same proportions as the index. Let's first assess the performance of these ETFs. As could be expected, all three graphs are overlapping and performance over the last 10 years are similar, with an average annual growth of about 13% and a max drawdown of about minus 23%. Hence, we have to examine the other criteria to check if there is any difference. SPY shows a higher market cap with above $400 billion, while the other two are about $300 billion. Similarly, the liquidity is also much higher with $32 billion exchanged daily for SPY, while VOO and IVV are only around $1.5 billion. The other criteria are similar, except for the expense ratio, which is 0.09% for SPY and 0.03% for the other two, 1/3. This is rather high. Hence, I would rather recommend VOO, which shows the best dividend yield and growth rate of the other two. You might be interested in living from your investment, and therefore from an income-oriented portfolio. Let's now see ETFs which have been designed mostly to pay high dividend rates. We will analyze 1. The Vanguard High Dividend Yield ETF, with the ticker VYM. It is offered by Vanguard and aims to track the performance of the FTSE High Dividend Yield Index. This index includes a broad range of large cap and mid cap US stocks, primarily focusing on those with above average dividend yields. 2. The iShares Select Dividend ETF, or DVY, issued by BlackRock. The ETF tracks the performance of the Dow Jones U.S. Select Dividend Index, which is composed of high dividend yielding U.S. equities. Historically, this ETF has had significant allocations to sectors like utilities, financials, and industrials, among others. However, this can change over time. 3. The Schwab U.S. Dividend Equity ETF, with the ticker symbol SCHD, which is managed by Charles Schwab. This ETF is designed to track the performance of the Dow Jones U.S. Dividend 100 Index, which includes high dividend yielding U.S. stocks. If we first compare the performance of these ETFs over the past 10 years, SCHD is clearly above the other two with an average annual growth of almost 13%, while the other two are about 10% and 11%. The max drawdown of SCHD is about minus 22%, lower than the other two. Regarding the other criteria, the market cap of SCHD is similar to that of VYM, with about $49 billion, with about 1/4 of the number of holdings, 100 versus 400, a much higher dividend growth rate over the last 5 years, more than double, and also higher liquidity with about double volume of exchange shares daily, 2.69 million. Hence, the conclusion here is easy. SCHD is clearly the winner. The ETFs analyzed so far were composed of stocks. Let's now see ETFs composed of bonds. Before we dive into this, it is important to note several points. First, what are bonds? Bonds are financial instruments that represent a form of debt. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments, the coupon, and the return of the bond's face value, also known as its principal, at a specified future date, known as the maturity date. Bonds are commonly used by governments, municipalities, corporations, and other entities to raise capital for various purposes. Bonds can be bought and sold in the secondary market before their maturity date. The market price of a bond may be different from its face value and is influenced by factors such as changes in interest rates, credit quality, and market demand. Some bonds are callable, meaning the issuer has the option to repay the bond before its maturity date. This feature can affect the bond's price and potential returns. Bonds are considered less risky than stocks, as they provide a more predictable stream of income based on regular interest payments at fixed intervals, which are predetermined at the time of purchase. However, they come with their own set of risks, primarily related to interest rate changes and credit risk. The risk that the issuer of the bond may default on its payments. Interest rate increases can lead to a decrease in the value of existing bonds, potentially impacting their resale value. Stocks, on the other hand, offer the potential for capital appreciation over the long term, but they also carry higher market volatility and uncertainty. In this part, we will assess various bond-based ETFs. 1. The Vanguard Total Bond Market Index, with the ticker BND offered by Vanguard. The BND ETF seeks to track the performance of the Bloomberg Barclays U.S. Aggregate Float-Adjusted Index, which includes a wide range of U.S. government, corporate, and mortgage-backed bonds. 2. The iShares 20-plus year Treasury Bond ETF, or TLT. This ETF tracks the performance of the ICE U.S. Treasury 20-plus year bond index. This index consists of U.S. Treasury bonds with maturities greater than 20 years, long-term, and is managed by BlackRock. These bonds are usually considered to be among the safest investments available because they are backed by the U.S. government. 3. The Schwab Intermediate Term U.S. Treasury ETF, with ticker SCHR. This ETF is offered by Charles Schwab and is designed to track the performance of the Bloomberg Barclays U.S. Treasury 3 to 10-year bond index. It provides investors with exposure to U.S. Treasury bonds with maturities ranging from 3 to 10 years. Let's compare the performance of the three ETFs over the last 10 years. As you can see, there is a huge volatility of the TLT ETF and an average annual growth of below or around 1%. Which is really low compared to stock-based ETFs analyzed before, and the max drawdown is minus 41%. The best choice is clearly BND, with the highest market cap, almost $95 billion, the highest performance, although very low, the highest diversification, with almost 18,000 holdings. As you might have understood, I am not a fan of bond-based ETFs. However, it's essential to consider your overall investment goals and risk tolerance, and a well-diversified portfolio may include a mix of both asset classes to achieve a balanced investment strategy and cover all market conditions. Another way to potentially diversify your portfolio without directly purchasing and managing physical real estate properties is to buy an ETF composed of real estate assets. So let's explore the following ETFs. 1. The Vanguard Real Estate ETF, or VNQ. This ETF is managed by Vanguard Group and is designed to track the performance of the MSCI US Investable Market Real Estate 2550 Index. The ETF primarily invests in real estate investment trusts, REITs, which are companies that own or finance income-producing real estate across various sectors, such as residential, commercial, and industrial properties. VNQ typically pays dividends to its investors, making it attractive if you are an income-oriented investor. 2. The iShares US Real Estate ETF, with the ticker IYR. This ETF is designed to track the performance of the Dow Jones US Real Estate Capped Index. It allows you to gain exposure to a diversified portfolio of US real estate assets, including real estate investment trusts and other real estate-related companies. 3. The Schwab US REIT ETF, with the ticker symbol SCHH. It is managed by Charles Schwab Investment Management. It tracks the performance of the Dow Jones Equity US All REIT Capped Index, which gauges the performance of publicly traded real estate investment trusts, REITs, in the United States. The ETF's portfolio would typically include holdings from various sectors such as residential, retail, office, industrial, and more. The performance of these ETFs is subject to the risks associated with real estate, such as changes in property values, interest rates, and market demand. Let's first examine and compare the performance of these ETFs over the last 10 years. If you had invested $10,000 in 2013 and reinvested the dividends, you would now have roughly $19,000 with both VNQ and IYR, and only about $16,500 with SCHH. This represents an average annual growth of about 6% for the first two ETFs and 4.8% for the third one, with a max drawdown of minus 29% for the VNQ and IYR and minus 30% for SCHH. Hence, VNQ seems to be the best. This is confirmed by the other criteria we discussed. VNQ appears to have the highest market cap with almost $32 billion, the highest dividend yield with 4.66%, while the other two are only slightly above 3%, and the second highest liquidity with 4.39 million shares exchanged daily, corresponding to $356 million. Hence, the winner is clearly VNQ. Now, to give an overview of our conclusions, we will compare the podium top ETF of each class we studied. These are VTI for total US market, IEFA for global market excluding US, VOO for S&P 500 tracking, SCHD for high dividend paying ETFs, BND for bonds ETF, and VNQ for real estate. Here is the performance graph comparison of the performance of these ETFs. The three ETFs based on US stocks, VTI, VOO, and SCHD show the highest performance of about 13%, with slightly better results for VOO and similar max drawdown data for all three, slightly above 20%. Then come the global and real estate ETFs, IEFA and VNQ, with around 6% average annual growth, slightly better for VNQ, but with max drawdowns higher than those of the US market ETFs, about 29%, despite a lower performance. And then the bond ETF, BND, with only about 1% average annual growth, less than inflation, with a max drawdown of 17%. However, if one considers the other criteria, especially dividend yield and expense ratio, the ranking is very different. The highest dividends are paid by VNQ, real estate, with 4.66%, but also the highest expense ratio of 0.12%. Then comes SCHD with 3.53%. This seems logical as it is the dividend-designed ETF. The expense ratio is 0.06%, half that of VNQ for only 1.3 times lower dividends. The third on the dividend podium is BND, the bond ETF, with 2.99% and only 0.03% expense ratio, a fourth of VNQ, for 1.5 times lower dividends. Then comes IEFA, the global market ETF, with 2.44% dividend yield and a relatively high expense ratio of 0.07%. And only then comes VTI and VOO, the US market ETFs, which were the winners of the performance criteria. All these ETFs have high market cap and high liquidity, so there shouldn't be any concerns on those aspects. Hence, the choice really depends on you, what you expect most, dividends or long-term performance, and if you prefer to invest only on the US stock market or diversify more with real estate, bonds, or global stock market. But whichever way, I highly recommend investing in ETFs. If you want an even better performance with a lower drawdown, you can also copy my portfolio. Let's compare the results of my portfolio with the two best performing ETFs we just analyzed, VTI and VOO, since 2016. The two ETFs have a performance of about 17% per year, while my portfolio shows an average annual growth rate of more than 22%. But maybe you think, yes, okay, but this is with very high volatility. Nope. The max drawdown of the two ETFs is around minus 20%, while that of my portfolio is around minus 15% only, almost 5% less than those of the two ETFs. And this is without taking into account my secret booster. If we now compare the performance with that secret booster since 2016, the average annual growth is almost 30%, with only a slightly higher drawdown, minus 15.74% instead of minus 15.39% without that booster. So it's entirely up to you and your strategy. You can either buy ETFs and spend time only when you buy them, or dedicate a few minutes per month to your investments, as my portfolio is updated every month and have a better performance. But take good care of your money. If you do nothing, you lose daily, just because of inflation. If you liked this video, feel free to watch this one, which is complimentary. Thanks for watching. Goodbye.
Today, we'll see the 4 secret tricks developed by Josh Kaufman in the personal MBA that any investor or businessman should use to achieve their goals. Deliver value, from product creation to delivery and overall customer experience. Businesses exist to create and deliver value. Let's inspect the different steps of business. First, value creation. It is the heart of business, the secret sauce that keeps any successful business ticking. In the personal MBA, Josh Kaufman says, you want to nail business? Figure out what people need or want, craft a product or service designed to meet that need, and then deliver it. Think Apple. They didn't just make cool gadgets. They dug into what customers really wanted. A smooth, easy-to-use tech experience. They created it and delivered it. The result is a devoted customer base and, consequently, a company net worth above $2 trillion mark in 2021. Remember, value creation isn't limited to just products. It extends to services, customer experience, and even brand perception. It's about understanding what your target market needs, desires, or is willing to pay for, and then designing your offerings around these factors. Marketing is vital. Next, Josh Kaufman spotlights marketing as a game changer in business. Marketing isn't just about selling your stuff. It's telling a story that makes folks sit up and say, I need that. If nobody knows your product or why it's awesome, it won't sell. Simple. And here's where human psychology comes into play. Like how marketeers use scarcity to drum up demand, limited editions, flash sales, or countdown clocks. This trick plays on our fear of missing out and can drive sales through the roof. But psychology isn't only for selling. It's also key in understanding customer problems and creating solutions they'll love. In short, mastering human psychology is business critical. Mastering sales is the trick. Then comes sales. This is where your super product and killer marketing come together to convince people to buy. But mastering sales isn't just about you or your product. It's about your customer too. Understand their needs, fears, and objections, earn their trust, and you'll turn browsing into buying. Ensure value delivery. The next step in the process is value delivery, which is often overlooked, yet absolutely essential. You've pitched your product, the customer's on board, and now it's time to deliver. This isn't just about getting the product in their hands, but ensuring they're thrilled with it, making sure you fulfill the promise made. Imagine selling a cutting-edge software. Your job doesn't end when they buy it. You have to make sure it works properly, the client understands how to use it, and it delivers on every promise. Get this right, and you've got a happy, loyal customer spreading the word about you. We'll now see secret number 2, but before, if you're interested in investing in the stock market, you could copy my investment portfolio, which has an average growth of 17.89% per year since 1998. You can copy-paste what I do with less than an hour work per month by clicking the first link in the description of this video. Secret 2. Grasp finance. It's what keeps your business going. The second secret of the personal MBA is finance, the backbone of any enterprise, big or small. With a firm grasp of financial principles, entrepreneurs can better manage their resources, optimize profits, and minimize losses. Imagine finance as the engine in your business's car. It keeps you moving forward, letting you bring in revenue, handle cash flow, and keep an eye on spending. It's about making wise decisions on where and when to invest and being careful not to overspend. Trim your expenses by 10% and see your profits get a boost. Every dollar saved in unnecessary expenses is a dollar that can be invested elsewhere in the business. The world of finance can feel like a maze, but navigating it is crucial. Keep a close eye on your books. Look for ways to get better and always remember the bottom line. And it's not just about watching the cash come in. Understanding financial metrics, knowing when to invest, and managing risks helps you make the right calls. It's about deciphering balance sheets and cash flow statements, understanding the impact of changes in interest rates or market volatility on your investments. It's a lot, but that's what keeps your business rolling. Secret 3, master the human element, the people side of business. The third secret taught by Kaufman is how understanding human psychology can help you develop your business at every level. But it's not all about understanding others. You also need to understand yourself. First, Kaufman explains how cognitive biases, decision-making patterns, and emotional triggers can significantly affect the way you approach business. Ever heard of confirmation bias? That's when you favor information that confirms your pre-existing beliefs. By recognizing this, you could avoid going all in on a venture just because it aligns with what you already believe. Kaufman also delves into how our brains love shortcuts, known as heuristics, when making decisions. While these can be handy, they can also lead us to systematic biases or errors. Recognizing this can help you make more rational, clear-headed decisions. Kaufman highlights the need for introspection and self-awareness, discipline, motivation, and focus. The entrepreneur who can set personal goals, manage stress, and stay motivated has a good shot at success. Kaufman suggests methods for maximizing productivity, like the Pomodoro technique, where you break work into 25-minute chunks with 5-minute breaks in between. Taking care of yourself is not a luxury or an afterthought in business. It's a key driver of sustained success. Lastly, Kaufman underlines the importance of working well with others. He talks about the power of negotiation, persuasion, and leadership in a business. Whether it's with your employees, customers, or business partners, the ability to communicate effectively, collaborate, and build strong relationships can make or break your success. Kaufman also covers strategies for effective communication, conflict resolution, and how to motivate a team. And remember, a dash of empathy and emotional intelligence help a lot in business relationships. For instance, a business dispute can be resolved more effectively if you can understand and consider the other party's perspective. Similarly, a team member might be more motivated to work harder if they feel valued and understood. Secret 4, understand, analyze, and improve systems. Comprehend business systems. For the fourth secret, Kaufman develops the idea of business as a complex system, kind of like a huge interconnecting puzzle. Understanding this system is vital to improving efficiency and boosting your business performance. It's like a map that guides you towards smart strategies and growth. Whether you're looking at your organizational structure, supply chain, or customer relations, spotting bottlenecks, areas that could work together better, or places that need improvement can seriously boost your efficiency and profits. But just understanding your business isn't the end game. You've got to dissect it. It's like taking a magnifying glass to each piece of your business puzzle, seeing how it works and how it fits in with the other pieces. This way, you can identify golden opportunities and weak spots. Analyzing your system can also help you see any threats looming on the horizon and give you a heads up on potential problems. This forward-thinking approach can save you resources, help avoid disruptions, and sharpen your strategy. For example, if you know a piece of machinery is about to give out, you can replace it in time, avoiding a costly hiccup. Kaufman also stresses the importance of always striving for improvement. Always be on the lookout for ways to do better, offer more value, and stay ahead of the competition. Say your production line has a bottleneck at the assembly stage, you could add more assembly stations or automate some tasks to make things go smoother. Doing this could increase your output and maybe even your profits. Examples of strategies for improving your system are reducing waste, ramping up efficiency, and introducing innovative solutions. So use Kaufman's book as a roadmap to entrepreneurial mastery. If you like this video, feel free to watch this one. I'm sure you'll love it too. Thanks for watching. Goodbye.
Today, we'll see the 5 lessons we can learn and apply for ourselves from the life and strategies of Charlie Munger, the associate of Warren Buffett at Berkshire Hathaway. Let's dive immediately into the first lesson. Lesson 1. Charlie Munger, together with Warren Buffett, manages several $100 billion with Berkshire Hathaway. Have you ever wondered what makes them such grand wizards of the investment world? What's their magic potion? Well, let me tell you their first secret. It's called understanding. Now you might think, understanding? Really? That's it? But let me explain. Charlie wasn't about just picking any flashy, trendy stock that was making headlines. He insisted on knowing the ins and outs of a business, sort of like checking out the engine before buying a used car. You wouldn't want to spend your savings on a shiny car that's going to break down the moment you hit the highway, would you? Charlie treated investing the same way. He wanted to see under the hood of the company, know its strengths, understand its weaknesses, and get the whole picture before investing. Makes sense, right? But hey, nobody's perfect. Let's talk about the story of Dexter Shoes. Charlie Munger and Warren Buffett thought they'd hit a home run with this one. The company was doing well, raking in profits. It was like finding a classic car with a purring engine, or so they thought. But the thing was, they overlooked a big detail: competition, specifically cheap imports from abroad. Just like finding out that the classic car you bought has a leaky oil tank, they saw their investment slowly losing value. It was a big, expensive lesson, but it reminded them why Charlie's understanding before investing rule was so vital. So the next time you're tempted to jump into an investment because it's the next big thing, remember Munger's advice. Take the time to understand the business first. Look beyond the hype, do your homework, and make sure you know what you're getting into. Lesson 2. The second secret for their magic potion isn't unicorn tears or dragon scales. It's brewing with a hearty dose of patience. Yep, you heard it right, patience. Munger and Buffett play the game just like a seasoned baseball player at the plate. It's all about the wait for the fat pitch strategy. Picture this. You're up at bat, the crowd is watching, and the pitcher is winding up. He throws a curveball, then a slider, maybe even a knuckleball. You could try to hit each one, but chances are you'll strike out or at best hit a foul. Instead, you wait for that perfect pitch, the one you know in your gut you can send soaring into the stands. That's what Munger and Buffett do. They don't jump on every hot stock or fall for every market trend. They wait for that perfect moment, a valuable company with a solid future, priced below its true worth. It takes time to spot such opportunities, and it takes patience to wait for them. So, the next time you feel that itch to jump on a bandwagon or make a hasty investment decision, take a leaf out of Munger and Buffett's book. Cool your jets, evaluate the situation, and be patient. Your fat pitch will come, and when it does, you'll be ready to hit it out of the park. As they say, good things come to those who wait. We'll now see lesson number 3. But before, if you want to invest in the stock market, you can copy-paste my investment portfolio, which has an average annual return on your investment of 17.89% per year since 1998. This is 10% higher each year than if you invested in the S&P 500, with a much lower risk. You can copy-paste what I do, even if you are a complete beginner, with less than an hour work per month. If you want to know more, feel free to check the first link in the description of this video. Lesson 3. Ready to dive into Charlie Munger's third secret? He's a lifelong learner, always on a quest to know more, and this isn't just some hobby. No way. This thirst for knowledge is his secret sauce, his Jedi force in the world of investing. In our world, everything's related in some way, right? The economy, technology, social trends, they all influence each other. Munger saw this interconnectedness and used it to his advantage. He didn't limit himself to learning about finance and economics. Nah, he dived into a whole smorgasbord of fields: psychology, history, science. That's his multidisciplinary approach to investing. Now, you might think, that sounds like a lot of work. Why bother learning about all these different fields? Well, imagine you're trying to solve a jigsaw puzzle, but you're only using pieces from one corner of the puzzle. You're missing out on the big picture, right? Munger understood that to make smart investment decisions, you need to look at the whole puzzle. Every piece of knowledge adds a new dimension, a new perspective. So what's the takeaway from all of this? Simple. Stay curious. Don't limit your learning to one field or one perspective. The more you learn, the more connections you'll see, giving you a comprehensive view of the big picture, and the better your investment decisions will be. Keep feeding your brain, and it'll thank you for it. Lesson 4. The fourth secret of Charlie is as simple as avoiding mistakes. Rather than striving to be exceptionally smart, Munger places a greater emphasis on avoiding foolishness. He sums it up perfectly with his quote, "It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid." Consider this. You're on a road trip. You've got your snacks, your favorite tunes, and the open road ahead. You don't need to be a world-class racer to reach your destination. What you do need is to avoid running out of gas, getting a flat tire, or driving the wrong way. It's about avoiding the mistakes that can derail your journey. It's the same with investing. You don't need to hit a home run with every investment. But what could set you back is making a major blunder like investing all your money in a high-risk venture or failing to diversify your portfolio. The magic lies in sidestepping the pitfalls. So, what's the take-home message from Munger's story? Next time, when you're about to make an investment decision, remember Charlie's words. The focus isn't to make a mind-blowing move every time. Instead, it's about not making a silly mistake that could set you back. In the long run, the fewer mistakes you make, the better your chances of success. Lesson 5. The fifth lesson from Charlie Munger is his resilience. His personal life is a testament to his ability to overcome adversity. His resilience is a valuable lesson for anyone facing challenges, both personal and professional. Charlie didn't just excel in the financial world. He also mastered the art of bouncing back from adversity in his personal life. It's a testament to his incredible resilience, a quality that's as valuable in life as it is in investing. Just think about it. Life threw him curveballs, from losing his son to dealing with personal health issues, including blindness in one eye and deafness in one ear. Yet each time, Charlie dusted himself off and got back in the game. He didn't let misfortune define him. Instead, he defined himself through his response to those trials. It's a bit like being a surfer. You're out there on your board, the wave crashes over you, and you're knocked underwater. But what do? You come back up, gasping for air, ready to ride the next wave. That's exactly what Munger did. He didn't just survive the waves, he learned how to ride them. And the lesson he imparts to us? Challenges, whether personal or professional, are inevitable. But how we respond to them, that's up to us. We can let them knock us down, or we can use them as stepping stones, as Munger did. So whether you're facing a personal setback or a professional hurdle, remember Charlie's example. Resilience isn't just about getting back up. It's about coming back stronger. If you liked this video, I'm sure you'll love this one too. Don't forget to hit the like button and subscribe to the channel, and I'll see you in the next video. Thanks for watching. Goodbye. Let's take a trip back in time and learn from one of the richest men in history, a real-life titan of industry, Andrew Carnegie. At the end of the video, we will see the 5 lessons you can learn from him and implement immediately to lead your business towards success. Let's jump into the first lesson and unpack a gem from the life of Andrew Carnegie. Imagine a little boy working 12 hours a day in a Pittsburgh cotton factory for just $1.20 per week. The work is harsh and the hours seem endless. This was the reality for young Andrew Carnegie, a 12-year-old immigrant from Scotland who started his career as the bobbin boy. The wealth and influence he later achieved seemed virtually unattainable from where he stood. Yet, Carnegie had something working in his favor: a voracious appetite for knowledge. In an era before public libraries, books were a luxury young Andrew could not afford, and his formal schooling had been limited to 4 years in Scotland. However, Colonel James Anderson, a wealthy local man, recognizing the value of self-education, opened his private library to working boys, giving them access to hundreds of books. Andrew seized the opportunity and opened himself to a world of ideas and wisdom. He spent his scant free time buried in Anderson's books. Can you imagine the sight? A tired, dirty boy after a long day of work, now burning the midnight oil over books, gobbling up everything from history to literature, business, and innovation. So what's the lesson for you to take away? Simply put, never stop learning. Imagine being a sailor, your ship Curiosity, constantly discovering new islands of knowledge, books, webinars, seminars, networking. Knowledge is power by opening doors to new ideas and opportunities. Don't limit the exploration. Visit islands of various fields, not just business. See each new topic, arts, culture, science, history as an undiscovered island. Broadening your worldview and understanding diverse cultures and people can help you connect better with diverse clients, employees, and partners. Don't forget to seek guidance from seasoned sailors who've navigated these waters before you and know more. Your mentors. Imagine a scenario when you're stuck in a storm, a challenging situation, but a message in a bottle, mentor's advice, guides you out of it. See yourself on a never-ending journey, sailing on a boat powered by knowledge, constantly navigating towards success. Let's dig into the second lesson. In the middle of the 19th century, the American Civil War was underway. For most, it was a time of dread and uncertainty, but for Andrew Carnegie, it was a time of opportunity. During the war, he noticed that iron was being used everywhere, from cannons and ships to railways. He realized that iron was going to support the country's growth in the coming years. So, what did Carnegie do? He made a bold move. He left his comfortable job as a superintendent of the Western Division of the Pennsylvania Railroad Company and bet everything on his vision, establishing the Keystone Bridge Company to make iron bridges. He could see a future that was going to be built on a foundation of iron, and he positioned himself right at the heart of it. Later, he would pivot to steel, seeing that it was stronger and more versatile than iron, and established the Carnegie Steel Company. This kind of clear vision led him to become the titan of the steel industry. So what's the lesson to grasp? Have a clear vision, see potential where others only see the ordinary, and take calculated risks. Your success in business isn't just about how hard you work, but how smart you work. It's about seeing the big picture, about understanding where the market is going and positioning yourself to take advantage of it. Let's take a concrete example. In the 1800s, during the gold rush, it was not the prospectors who got rich, but the sellers of shovels and pickaxes. They had understood that a large part of the population was going to look for gold and that they would need tools for that. And they had prepared to sell them what they would need. We'll now see lesson number 3, but before, if you